So Alibaba's delisting news is getting a little bit out of hand. At this rate Alibaba is going, it might be a net positive if China is the one that initiated the delisting by having an official homecoming for all these US listed Chinese stocks. So due to the purely coincidental nature of when the delisting narrative is being exacerbated again whenever there are disagreements between the two superpowers, I truly believe that this is not a political tool for manipulation. Okay, enough with the sarcasm. On a more serious note, it does seem like as the day goes by, delisting seems like a more legitimate concern. Despite some bigger voices online on Seeking Alpha or even YouTube saying that they believe that delisting is not possible, I had made my position very clear from the start back in July 2021. Let me play a short clip from then and look at the younger Chi King.
But I would like to say that why did I put a probability of 50-50? Because ultimately, both of them can walk away from this table without a deal. Big companies like Alibaba, Tencent, JD.com can continue listing in the Hong Kong exchange, while at the same time the US exchange are also not desperate for access to all these different Chinese companies. So this is the main problem right here. How are they going to discuss further? How are they going to negotiate further? No one really knows in the entire world right now. It really depends on what happens in the closed doors of all the different chambers that they're explaining and pushing forth the different agendas. So I'll just leave the delisting risk argument right there. You be your own judge.
Now, some of you might ask, despite being so pessimistic about the potential of a delisting, why am I still invested? The short answer is, I don't really care about the delisting event. I'm more concerned with China invalidating the VIE agreement, and that would be the real rug pull of the century. But that being said though, I initially thought that investors who are uncomfortable with this delisting risk had already started selling out way earlier on, and that was what I have underestimated. By the day, it seems like people are starting to adapt to this new normal where more and more quote-unquote experts are saying that delisting is real. So even the CIO of Crane Shares gave his opinion on what the asset management company has been doing over the past year, which is to actively convert their ADR to those Hong Kong listed shares. But clearly, it's not helping the prices of all these stocks at all. I'll play a short clip of what he said.
Now is Brendan Ahern. He is the Chief Investment Officer. Brendan, it's just been going from bad to worse. And this is at a time when the macro guests on China have been saying they're turning a corner, the tech crackdown is over, this is the time to get in. You can at least feel comfortable maybe buying alongside Charlie Munger, but this seems to have come out of nowhere.
Well, it shouldn't be a surprise that since the passage and signing of the Holding Foreign Companies Accountable Act, we at Crane Shares have taken this very deadly serious. We've started to convert. We've moved KWeb. We've moved a significant portion of our US ADRs, converted them into the Hong Kong share classes in anticipation that the SEC will fulfill its obligation as the enforcement agent for the Holding Foreign Companies Accountable Act. And clearly there's market participants who haven't taken that very seriously or were unaware of it or unaware of ADR conversion. And so we're seeing this horrific indiscriminate selling of US listed Chinese ADRs on the specter of ADR delisting in 2024.
Right, but you guys have been doing this for some time, haven't you? I thought we discussed this for a long time.
Oh yeah. Certainly, since this, when this was a bill, we've been spending a lot of time on protecting our shareholders. And so, a year ago, Kelly, KWeb was only 25% Hong Kong. Today, it's 66% Hong Kong. And by the end of this year, if not significantly sooner, we will have completely removed US ADRs out of KWeb. And we highly recommend investors find out about ADR conversion, about doing this transition that we've been doing on behalf of our shareholders in KWeb.
Sure. I guess the reason why I just want to scratch a little below the surface here is this was a known to you. It's about converting, from US ADRs to Hong Kong. Fine. So why is the Hong Kong market itself doing so poorly right now? The Hong Kong market is at a 5-year low. We've seen what's happening with COVID cases in Hong Kong, and now there's some concerns about that having similar effect in China. I guess my point is, I'm just not totally convinced that this indiscriminate selling it may be catalyzed by this issue, but it doesn't seem to be fully explaining the behavior of Hong Kong and Chinese stocks right now.
Well, we've seen a significant disparity over the last year between the fundamentals of the companies and the price action. And so foreign investors who really reflect their opinion of China and China's economy through Hong Kong and US shares have been very negative. We can contrast that with what do investors in China think about China? So the Shanghai and Shenzhen composite were up 9 and 13% last year. So you have this incredible disparity between what the Chinese think about China and what foreigners think about China. And so some of this, it could be US-China political relations, it could be China internet regulation, it could be tax loss selling in the individual names, as we saw in November and December. The culmination, the sum of all fears, is really reflected in the US and Hong Kong names. We can contrast that with the A-share market, the Shanghai, Shenzhen. If you just do KBA versus KWEB, you can see that disparity.
Sure, and absolutely that's going on. Would you say, though, that there's no larger macro concern here as it relates to what's about to happen with the Hong Kong or Chinese economy?
Well, we think China's economy is getting ready to ease as the world is on the precipice of tightening. So I think this is a little bit like, listen, we could argue all day why China's why people should be buyers and not sellers, but the price action is what it is. There's certainly behind the scenes, if you do some homework, you'd see that China is easing monetarily, fiscal support, and I think they, hopefully, I think China has a real strong incentive to helping find a peaceful resolution in Hong Kong due to their importation of Ukrainian wheat and certainly natural resources on the Russia side.
So to add fuel to the fire, I know that oil is rather expensive now. Please remember to help me smash the like button, so to essentially help me tide over this inflationary period. We can see that last Thursday and Friday was a brutal day for Chinese equities. Thursday was primarily due to the new SEC list of 5 companies due to delisting, and Friday was probably because of the mess Didi got themselves into. So as you can see, Didi was down more than 40% in a single day, and that was because there was a suspension on their Hong Kong listing plans. So it was reported that the ride-hailing firm had suspended preparations for its Hong Kong listing due to its failure to meet China's condition on handling sensitive data. So if Didi is going to be delisted from the US, yet they also halted their Hong Kong listing, then what is going to happen to existing shareholders of Didi? So many questions, so little answers. With so much uncertainty looming around this basket of stocks, the sentiments on China just never seem to find a bottom, and that is effectively reflected in the stock prices. So just to reiterate my position, I understand where all this fear is originating from. So much uncertainty, so much heavy-handed interferences, so much commotion and development. But if you're to really dig deeper and keep a journal on these said developments, it's always the same actors responsible for the volatility. It's either the SEC, some cute management team that decides to go against the regulators, or it might have started from another dispute remotely between United States and China, which was why in the beginning of this video, there will definitely come a tipping point where the negatives of listing in the US outweighs the positives and the companies themselves decides to go back before the SEC tells them to get lost. Looking through how things have transpired thus far, it will not be pretty anytime soon. But don't forget, you're buying a business, not a lottery ticket. How does everything that was discussed earlier affecting the profits, cash flow, and margins of the company? I let you be the judge. With that, I'll see you in the next video, but more importantly, I'll see you on the moon. Goodbye!